RBA today cut the cash rate, as expected, sort of by 25 basis points to 3.6%. They said inflation has fallen substantially. The headline inflation has been affected by the temporary cost of living relief measures, and at 2.1%, of course, that's lower than the real number. They are forecasting that the underlying inflation will continue to moderate to around the midpoint of 2 to 3% range, with the cash rate assumed to follow a gradual easing path. So a little bit more later. Of course, timing is the question. Interestingly, they highlighted again uncertainty in the world economy. Real household incomes have picked up a little, although, of course, this is not uniformly spread, as we'll see in my analysis. Nevertheless, labour market conditions remain tight, unemployment rate at 4.3%, an average 4.2% in the June quarter as a whole. The utilisation remains at low rates, and the underutilisation, I say, remains at low rates, and business surveys and liaisons suggest the available labour is still a constraint for a range of employers. Well, that's a bit at odds with what Roy Morgan highlighted with the underutilisation. So there's something weird there. The quarterly volatility is also a concern, but looking through that, wages growth have eased and productivity growth has not picked up. And as we'll see, they had to make some assumptions about future productivity to the downside, which is quite interesting. They also then highlight again uncertainties about the domestic economic activity and also the international developments. They said there's a risk that consumption growth is a little slower than expected. Alternatively, real income and wealth could rise, and that means households could consume more, and that could actually lead to potentially higher inflation. And there's also uncertainties about the lags effect in terms of when monetary policy happens and how firms' pricing decisions and wages will respond. And they specifically made the point, actually, quite interestingly, that some firms have seen higher input costs, but so far are eating those costs rather than actually transferring them into the price of goods to consumers, which implies potentially higher inflation down the track. We'll watch for that later. And I do think this uncertainty question and the lag between pulling the lever and seeing what happens is quite significant. Anyway, they did actually say, as a result of all this, that they judge further easing of monetary policy as appropriate. We've seen 75 basis points of easing, of course. They're cautious about the outlook, heightened levels of uncertainty. They'll be attentive to the data and the evolving assessment of the risks, and they will continue to focus on price stability and full employment, and will do what it considers necessary to achieve that outcome.